Welcome back to the second part of working capital management. That is, we begin where we left at disadvantages or dangers of holding inadequate working capital. Yeah, disadvantages of holding inadequate working capital. Say holding inadequate cash. We all know the troubles we go through if we have no cash in our pockets. If we have inadequate cash, yeah. So the same case, a business will go through problems if it doesn't have enough cash, if it doesn't have enough working capital, if it doesn't have enough stock in its store. So one of the disadvantages is that a concern or a business which has an adequate working capital cannot pay its short-term liabilities as and when they fall due. Therefore, it will lose its reputation and shall not be able to get good credit facilities. So that is how bad it can be. So the business will not be able to pay its short-term liabilities as and when they fall due. It will therefore lose its good reputation with the suppliers. It will lose its goodwill with the suppliers, and as such, it will not be easy for it to obtain credit in future. So it will interrupt its smooth operations. Again, number two, the business may not be able to buy in bulk, and thus it can lose the opportunity to take advantage of cash discounts from its suppliers. Yeah, so cash discounts come with large quantities. So suppliers will sell to the business on credit basis. Suppliers will award or will give a discount on the basis of the quantity purchased. So the higher the quantity purchased, the higher the trade discount you're given. So to take advantage of these trade discounts, then you need to buy in large quantities so as to take advantage of the discounts that the suppliers are giving. So if the business doesn't have enough cash, it will not be able to buy in large quantities, and as such, it will not be able to take advantage of cash discount that is being offered by suppliers. Another uh, a disadvantage of inadequate working capital is that it becomes difficult for the business to exploit favorable market conditions and undertake profitable projects due to lack of working capital. The business will not be able to take advantage of opportunities that may arise because it doesn't have cash with itself. Yeah, since the business doesn't have cash, it will not be able to take advantage of market opportunities. Yeah, so the opportunities will just come and go without the business being able to take advantage of them because it doesn't have enough cash. Number four, disadvantage, the business will not be able to pay its expenses, the day-to-day expenses of its operations, which will create inefficiencies, increase the cost of production, and in the end, lower the profitability of the business because the business doesn't have enough cash. So without enough cash, the business will not be able to pay day-to-day expenses. As such, there will be inefficiencies, there will be increases in cost, there will be reduction in profitability. Say, for instance, the cost of fuel. It's a manufacturing company which needs fuel or electricity for production. So the business doesn't have enough cash to pay for, say, electricity. Power is disconnected because of the arrears. As such, the business will not be able to operate. So this will lead to inefficiency. This will lead to reduction in profit. Again, uh, dangers of holding inadequate working capital is that the return on investment will also fall because we've seen that the profitability will go down because of holding inadequate working capital. So when the profitability is low, the return on investment to the business will be low. So those are the dangers and advantages of holding excessive working capital and the dangers of holding inadequate working capital. So it's good that the business maintains an optimum level of working capital. So not too high, not too low, so that it may be able to take advantage of opportunities, and at the same time, it may be able to remain profitable, and at the same time, be able to minimize the cost of holding idle working capital. Thank you. So we move on to the management of the various items in the working capital. We begin with cash. So you know that in the working capital, we have cash, we have debtors, we have stock. So cash can be both cash in bank and cash at hand. So how we begin with the management of cash. So how do cash problems arise? So cash problems arise through making losses. So making losses, you are paying more than we are receiving. So that will lead to an outflow of cash. Yeah, the cash outflow is more than the cash inflow. So you can predict the net effect is that the business will lose its cash position as a result of making losses. Also, inflation will lead to a loss will lead to a cash problem. Inflation. We all know that inflation is the persistent increase in general price levels. So if there is high inflation, it means that the cash outflow will be high because the business will need more cash to buy for commodities whose prices have increased. As a result, the cash outflow will be more during inflation, which will lead to the decline in the cash position of the business. So then another reason is growth. So a growing firm needs to acquire more fixed assets and support higher amounts of stock and debtors in order to support its growth. Yeah. So for the farm to grow, it needs a lot of cash to be spent in acquiring those other fixed assets, in acquiring that land, in building on that other land. So for it to grow, it needs a lot of cash to be spent. So that will be an outflow of cash. So that may lead to a problem of cash. And then seasonal losses. Yeah. In periods of, say, recession, yeah, the business experiences losses. Losses will lead to the outflow of cash will be more than the inflow of cash. The net effect will be a cash problem. The business will not have enough cash. So seasonal losses, like say for example, the current conditions that we are experiencing worldwide, the coronavirus, COVID-19, we are all in a recession. So you're expecting that most businesses will experience a cash problem because of the losses that they have to experience. Yeah, you find that even many companies are cutting their employee salaries because of cash problems. So seasonal losses in the economy, in the global economy, will lead to a cash problem. And we can see the experience that people are going through at the moment because of cash shortages. Yeah, layoffs, salary reductions, and so on. So because of seasonal losses. And then number 5, another item that may contribute to a cash problem is a one-off item expenditure. So you incur a huge expenditure at once. So it leads to a massive outflow of money, which will lead to a cash shortage. So for instance, when in the payment of a huge debt, yeah, which has come due, you need to pay it off. A lot of money goes out. Also, in the case of purchasing of an expensive item, yeah. So you can equate the purchasing of an expensive item to you purchasing, say maybe a laptop, 30,000 shillings. You only had 40,000 in your as your savings. So it will lead you'll be in a poorer cash position than when you were before when you purchased that expensive item. So the purchase of an expensive item also happens in businesses. They acquire buildings, they acquire motor vehicles, they acquire fixed assets that will cost them a lot of money, which may lead them to a poor cash position. So look at the methods of easing cash shortages. So how do we salvage ourselves from a cash problem? One is postponing a capital expenditure. So a capital expenditure entails investment in a fixed asset, the acquisition of a fixed asset, the purchase of a fixed asset. So you've seen that a fixed asset is a one-off expenditure, huge expenditure, one-off huge expenditure, which will lead to a cash problem. So to save ourselves, maybe in this period of recession, we postpone or we put on hold that expensive expenditure in a fixed asset. That will safeguard our cash position. Number 2 is accelerating inflows, which would otherwise be expected in a later period. For instance, we can press our debtors to pay earlier. Yeah. tunawasukuma kabisa mpaka watulipe in good time. So when our debtors pay us in good time, then it means we have money, yeah, which will salvage our cash position. Number 3 is reversing a past investment decision. Yeah, so like in chapter 2, we did maybe, for example, we've done a capital budgeting technique. We've done net profits, net present value analysis, and made a decision to invest in project B. Yeah, so and then we experience a cash problem. So you can make the decision on postponing that investment so as to salvage ourselves in the present. Yeah, so that is by reversing a past investment decision. We put it on hold. Yeah, acha kwanza to yani hiyo project ikae kwanza, ingojee kidogo until we stabilize our cash position, so that we are able to maintain a good cash position. And then number 4, managing cash shortages is negotiating a reduction in cash outflow. So you can negotiate a reduction in cash outflow with our banks that have given us a loan. Yeah, so you negotiate for lower what? Lower payments. Yeah, so by negotiating rescheduled loan repayments with a bank, longer credit might be taken from suppliers, negotiating for delaying the payment of corporate tax, reducing dividend payments. Yeah, so negotiating a reduction in cash outflow. So with our banks, yeah, we plead for lower repayment amounts. Yeah, we negotiate with our suppliers. We negotiate for longer payment periods. If it's with our shareholders, we negotiate for lower dividends. Yeah, to minimize our cash shortage. So that is management of cash. Next, we move on to the management of the other item in the working capital, that is stock. Yeah, so we need to have our stock in adequate at the optimum levels. Yeah, so inventory needs to be in the optimum levels. So to manage stock, we look at the following 4 items as highlighted there. We look at the minimum stock level, we look at the maximum stock level, we look at the reorder level, and we look at the reorder quantity to help us manage stock. So what is the maximum? We begin with the minimum stock level. So what is the minimum stock level? So this is the level below which stock should not fall. Yeah, it's the buffer stock. Yeah, so as much as possible, the business should ensure that the stock doesn't go below the minimum stock level. Yeah, the stock doesn't go below a certain level. That is the minimum stock level. That is, at all times, the stock must be either at the minimum level or above the minimum level, but not lower than the minimum level. So it's also known as a buffer stock, the point at which stock should not fall. Yeah, so if the stock falls below this point, there is a danger of a stock out. Yeah, so how do we calculate the minimum stock level? The minimum stock level is equal to the reorder level minus, in brackets, normal consumption times the normal reorder period. So we shall have an example, a question to illustrate that. And then we have the maximum stock level. This is the upper limit with which stock should not be allowed to rise. So we've seen the dangers of holding excess stock. So to minimize these dangers of holding excess stock, it's important to have a maximum stock level where stock should not be allowed to go beyond, to rise beyond. Yeah, so the maximum stock level is equal to the reorder level plus the reorder quantity minus the minimum consumption times the minimum reorder period. So the maximum stock level is equal to the reorder level plus the reorder quantity minus, in brackets, the minimum consumption times the maximum reorder period. And then we have the reorder level. The reorder level is the point at which we need to order stock. Yeah, ikifikia mahali fulani, ikifikia hapo tuna order stock. such that by the time stock inakuja hatujaenda below the minimum stock level. Yeah, it's a point that lies between the minimum stock level and the maximum stock level at which purchase orders must be replaced to ensure that goods ordered are received before the minimum level is reached. It is a level of stocks at which replenishment must be made to avoid a stock out. So it's a point at which we order our stock so as to prevent us going below the minimum stock level, the reorder level. So the reorder level is equal to the maximum consumption times the minimum times the maximum reorder period. And then we have the reorder quantity. Reorder quantity is a quantity at which the business should order. Yeah, the order quantity, the quantity at which the business should order. So in most cases, the reorder quantity, we use the economic order quantity. That is the EOQ. Yeah, the economic order quantity is usually used as the economic order is usually used as the reorder quantity, the quantity at which you should always order. So when we reach at the reorder level point, what the quantity that we order should be the reorder quantity. Should be the reorder quantity, in which we normally use the economic order quantity. And the economic order quantity is the order quantity at which the cost of holding stock and the cost of ordering stock is at a minimum, so as to minimize the cost of the business. Yeah, so we shall look at the economic order quantity, which is a order quantity that minimizes the total cost of stock. That is the total cost of holding stock and the cost of ordering stock. So the economic order quantity is obtained using that formula. So the EOQ being the economic order quantity, which is equal to the square root of 2 multiplied by the annual demand of stock, multiplied by the annual demand of stock, times the ordering cost per order, that is CO. CO is the ordering cost per order, divided by the holding cost per unit, per annum. So CH is the holding cost per annum. So you have an example to illustrate those management of stock. So you have the following example. So the following information was extracted from the books of Danex Holdings in regard to its existing stocks. So you have that information on reorder quantity, reorder period, maximum consumption, normal consumption, minimum consumption, maximum and minimum reorder period. So we are required to determine the reorder quantity, the reorder level, the maximum stock level, and the minimum stock level. So the reorder level, as you've seen, is equal to the maximum consumption multiplied by the maximum reorder period. So the reorder level is maximum consumption times the maximum reorder period. So the maximum consumption, we have it here, it's 450. So therefore, you have 450 units multiplied by the maximum reorder period, which in our equation is 5 weeks. 5 weeks maximum reorder period, which will give us 2,250 units. That is the reorder period. Sorry, the reorder level is equal to the maximum consumption times the maximum reorder period, which gives us 450 times 5, which is 2,250 units. Yeah. So ikifika store ya huyu ya Danex, whenever the units get to 2,250, the business needs to reorder. Yeah, so that is the reorder level. So when the stock reaches this amount, 2,220, the business needs to reorder. So then the question requires us to do the maximum stock level. The maximum stock level is equal to the reorder level plus the reorder quantity minus in brackets minimum consumption times the maximum reorder period. So the reorder level we've seen, we've calculated it above, it's 2,250 plus the reorder quantity, we have it in the equation, it's 1,800. So 1,800 minus in brackets the minimum consumption times the minimum reorder period. So the minimum consumption, we have it in the equation here, it's 150, and the minimum reorder period is 3 weeks, yeah, as we have in the equation. So in the end, the maximum stock level we have is 9600 units. So for this company, the stock level should not go above 3600 units. And then you have the minimum stock level. The minimum stock level is the level below which the stock should not be allowed to fall. So the minimum stock level is equal to the reorder level minus, in brackets, normal consumption times the normal reorder period. So the reorder level, we've calculated it up here. It's 2250 minus, in brackets, 300 times 4, of which the 300 is the normal consumption. We have it in the equation here. And then times the normal reorder period, which is 4 weeks. We have it in the equation here. So once we do that, we'll get 1050 units. So this is the lowest level of stock that this business should always have. And then we have the economic order quantity. This is usually used as a reorder quantity of a business. So a business should always order at the economic order quantity point, because the economic order quantity is the ordering. The economic order quantity is the quantity at which the business minimizes the total cost of stock. There is a total cost of ordering stock and the total cost of holding stock. Yeah, we have the buying cost ya kununua store kuleta kwetu, and the cost of holding stock, or the carrying stock, the cost of the charges that we pay for the store, that is security charges, the insurance, the cost of the storekeeper salaries, and so on. So to minimize all that cost, we order at the economic order quantity. So below there, you have a graph that shows the relationship between on the horizontal axis, the quantity of inventory, and the vertical axis, you have the total cost. The total cost we have is the total of the ordering cost and the total of the holding cost. So we have three curves there. We have the one at the top is the total cost curve. And then we have this curve that increases with the with the quantity of inventory. That is the holding cost. So you expect the holding cost of inventory to increase with increase in quantity of inventory, because the more the stock we have in the store, maybe the more the security charges that we have to pay, yeah, to secure this stock. Yeah, the less the stock we have in the store, the less need we have with security. Yeah, if it's the same case with cash, if you show people that you have a lot of cash in your business, the higher the likelihood of robbers coming in, yeah, who might even in the end kill you. So as such, you may need to secure yourself more by paying more to security officers. So the higher the working capital, the higher the whole stock holding cost. And then the ordering cost, we have the other curve for the ordering cost, which decreases with the quantity of inventory. So a good example is with cash discounts and trade discounts. The more you buy in bulk, the more the discounts you're given. And the discount you're given is a discount received, which is a gain to the business, which lowers the cost of the business. So the ordering cost will be lower with the higher the ordering quantity. So when you add these two costs, that is the ordering cost and the holding cost, what we get is the total cost. So therefore, the total cost curve will be U-shaped like we have it here. Yeah, a U-shaped curve. So when you add the holding cost and the ordering cost, we have the total cost curve, which will be U-shaped like we have. So it will have a minimum point. So that point down there, I hope you can see how I'm highlighting this thing. This point. So down here, here is where we have the lowest point, where you have the lowest cost of stock. So this point here is the economic order quantity, whereby the total cost of ordering or total cost of stock is the lowest. Yeah, so the quantity at this point is the EOQ, the ordering quantity, the point at which the ordering of goods lowers, minimizes the cost of stock. So as such, the definition of EOQ is the quantity. Okay, the definition of EOQ is that it constitutes the quantity purchased of either stocks that is considered most optimum. By most optimum, it means the quantity that minimizes the holding cost and the ordering cost of stock. So we break down the ordering cost and the holding cost and the total cost further. So we have the formula. So the total cost is equal to the total ordering cost plus the total holding cost. The total ordering cost is equal to the cost per order times the number of orders per period. The total ordering cost is equal to the cost per order times the number of sorry, the total ordering cost is equal to the cost per order multiplied by the number of orders in a period, which is shown there. That is cost per order. Cost per order is shown by CO. CO here is the cost per order multiplied by the annual demand. Annual demand is shown by D. So D times C0, so that is D annual demand times the cost per order, CO, divided by the ordering quantity, Q. So I hope you see that. So the total ordering cost is equal to the annual demand times the cost per order divided by ordering quantity, Q. And then the total holding cost is equal to the average stock quantity divided by the holding cost per unit, which can be simplified by Q, which is the ordering quantity, Q multiplied by CH, which is the holding cost per unit. CH is holding cost per unit, and then divided by 2. So dividing by 2 gives us the average stock quantity. So average stock quantity is Q divided by 2, that is the ordering quantity divided by 2 times the holding cost per unit. And then the total cost is equal to the ordering cost times the holding cost. So the ordering cost, that is D times CO divided by Q, plus Q plus times holding cost, CH, divided by 2 to give us the total cost of both ordering and holding stock. And then we get the EOQ. The EOQ is equal to 2 times the annual demand times the ordering cost divided by holding cost per unit, and then you take a square root of that. So I repeat, the EOQ is equal to the square root of 2 times the annual demand times the ordering cost, the cost per order, divided by the holding cost per order. Yeah, so that is the EOQ. So in that case, the annual demand, EOQ assumes the annual demand is known, that is the D. Yeah, and it assumes that the holding costs are known, that is the CH, and it assumes that the CH and D, and it assumes that the ordering costs are known. Ordering cost is CO. Ordering cost is CO. Yeah, so you can replace them in the EOQ. So the annual demand times the the 2 times the annual demand D times the ordering cost per unit divided by the holding cost per unit, CH, will give us the EOQ. And we have an example here that ABC Limited has an aggregate demand of 1.2 million units. Each time they place an order, there is an ordering cost of 1,000 shillings and ordering cost of 1,000 shillings, and the holding cost is 100 shillings per unit. So determine EOQ. So EOQ is equal to the square root of, so as you can see here, EOQ is equal to the square root of 2 times the annual demand times the ordering cost per unit divided by holding cost per unit. We take a square root of that, which is equal to 2 times the annual demand, which is 1.2 million, 1 times 1.2 million times the ordering cost per unit, which is 1,000 shillings, divided by the holding cost per unit, which is 100 shillings, which gives us, we take a square root of that, to give us 4,899 units. So the number of orders is basically the annual demand divided by the order quantity. So 1.2 million divided by the order quantity, which is gotten to be as the EOQ of 4,899, which will give us 245 orders. And then the total cost, which is equal to the annual demand times the ordering cost per unit divided by the ordering quantity plus the average quantity, that is Q, ordering quantity divided by 2 times the holding cost per unit, which will give us 489,900 shillings as the total cost of this stock. So, and with that, we have the management of stock. Then next, we look at the last item of working capital, that is managing, that is debtors, managing of debtors, yeah, or accounts receivables. So debtors need to be put at an optimum level. So debtors are people who owe the business money. So proper management of debtors will ensure that you get paid faster and prevent bad debts. So prompt collection of debtors accounts will also help you maintain a healthy cash flow. So the business needs to have an optimum level of debtors. Zisikuwe mingi sana, debtors wasikuwe mingi sana. You know, the higher the debtors, the higher the likelihood of bad debts. And bad debts are lost to the business. So to avoid bad debts, you need to minimize the level of bad debtors. So how do we minimize the level of bad debtors? To minimize the level of bad debtors is that we need to collect debts on time. We pressure them to pay us on time. 2, we need to set credit limits. We need to have a credit policy, and a stringent one, that will help us lower the level of credit of debtors, so that we are able to sell on cash basis, we improve our cash position, and at the same time we are able to minimize our bad debts. Then number 2, we need to have credit checks. We need to evaluate our debtors so as to be able to assess their credit worthiness, so that we're able to sell on credit to those who are credit worth. And then we need to have to enforce a clear credit policy. And number 3, we also need to give cash discounts. Cash discounts encourage debtors to pay earlier, yeah, so they know when they pay in good time they are given a discount. So when you give them a cash discount, they will pay you in good time. So, and with that, we have the 6th topic of financial management. Thank you for your time.